navigating the road to $6,000 gold. Headwinds versus tailwinds is the precious metals rally just getting started. A recent financial analysis by Holly Mead in the Mail on Sunday highlights a striking prediction floating through major banking institutions. Gold could realistically target $6,000 per ounce in the long term. While a projected leap to $6,000 sounds extraordinary, prominent market researchers are treating the milestone with serious consideration. According to insights from JPMorgan's research team, a target price of $5,000 per ounce by the fourth quarter of 2026 is actively on the radar, making a subsequent push towards $6,000 a distinct possibility for long-term holders. However, the path to these historic highs is rarely a straight line. Following a powerful upward trajectory, the price of an ounce recently experienced a sharp 4.3% pullback. For sophisticated investors, this raises a critical question. Has the precious metals market peaked, or is this merely a temporary consolidation before the next major leg up? The macro forces driving the bull case. To understand where the market is heading, we have to look at the structural drivers behind it. Dmitry Lipsky, head of funds research at Interactive Investor, points to three massive macroeconomic tailwinds that continue to underpin the value of hard assets. Aggressive central bank accumulation. Global central banks are continuing to buy physical gold at historic rates, shifting away from fiat currency reserves. Escalating government debt. Surging sovereign debt levels across Western economies are driving concerns over long-term currency devaluation. Persistent global tensions, geopolitical instability naturally forces institutional capital into the ultimate historical safe haven. The contrarian view, what could cool the market? A balanced investment strategy requires weighing the potential headwinds. The ongoing bull market faces specific economic counterweights. If global inflation cools down faster than anticipated and central banks decide to hold interest rates higher for longer, the immediate upward momentum for non-yielding assets like gold could temporarily weaken. The bottom line for wealth preservation, short-term market corrections like the recent 4.3% dip are a normal feature of any healthy market cycle. Rick Kanda of the Gold Bullion Company remains heavily optimistic about the macro outlook, reinforcing the sentiment that the broader, long-term trajectory for precious metals remains exceptionally robust. For investors focusing on a legacy of wealth protection, these structural market dynamics reinforce a fundamental truth. Physical hard assets aren't about timing the daily market fluctuations. They are about securing foundational stability against systemic economic shifts.